Happy New Year to all of our readers. The Glassnode team hopes you had a safe and happy break over the holiday season. Also, happy birthday to Bitcoin. 13 years ago, Satoshi Nakamoto mined the first Bitcoin block with the following message encoded into the Coinbase transaction as a timestamp. The times 3rd of January 2009, Chancellor on brink of second bailout for banks. As 2021 went down, so too did activities in the Bitcoin market, with trading volume softening and prices trading more or less sideways. Price has continued to trade in the same range since late November, bouncing between a high of $51,000 and a low of $46,000 this week. Across many on-chain metrics, there is a general lack of activity, despite a modest bullish undertone in supply dynamics. Coins continue to migrate to increasingly illiquid and dominant wallets, while its investor profitability and cyclic metrics paint a more bearish picture. With a balance of both bull and bear signals at hand, our expectations into the start of 2022 are likely continued sideways consolidation. The first suite of metrics we will assess in this newsletter are associated with activity occurring on-chain. Generally speaking, bullish momentum is usually accompanied by increased demand of block space as coins are purchased, sold, and transferred to new owners. Conversely, bearish trends typically see fewer new wallets, reduced transaction demand, and lower network utilization. The number of wallet addresses with a non-zero balance is a metric that can be used to assess the longer-term demand for Bitcoin. Over the last year, a net total of 7.4 million non-zero balance wallets have been added to the network at 23.2% year-over-year growth. 1.4 million of these were added since the October all-time high, 18.9% of the yearly total. The current all-time high of 39.6 million of non-zero addresses is 40% higher than the peak set at the end of 2017 bull market, indicating that user base growth has been sustained over the last 5 years. With respect to daily activity, we can see that the number of active on-chain entities has finally managed to break above 275,000 per day. The chart below highlights in red an observable and rising bear market channel. This shows that during periods of depressed prices and lower relative interest, there remains a persistent growth in network users. Both 2017 and 2020 to 2021 bull markets stand out as having markedly more on-chain activity relative to this channel. However, the current regime appears to more closely resemble the mini bull that occurred from April to August 2019. These two periods are similar in that they followed a deep correction and broad capitulation event, but the subsequent rallies could not generate sufficient momentum for a full-scale bull market. The rally in 2019 eventually culminated into a 9-month-long sideways to down trading range, until the final capitulation occurred in March 2020. Transaction counts paint a similar picture, where the bull markets of 2017 and 2020 to 2021 stand out clearly, hitting over 300,000 transactions per day at the peaks. Again, similarities can be found between April to August 2019 and the current market since September 2021. In both cases, an initial burst of activity supported rising prices, but failed to sustain any meaningful momentum, with both transaction counts and prices rolling over. until there is a further expansion in demand for Bitcoin block space. It can be reasonably expected that price action will be somewhat uneventful and likely sideways at a macro scale. The underlying differences in market structures between the 2019 and 2021 to 2022 periods. The April to August 2019 rally was largely associated with heavy spot BTC demand due to the Plus token Ponzi scheme, coupled with multiple short squeezes as trades faded the move in futures markets. The current market is best described as strong rally of the July and September lows following heavy accumulation. This rally was sold into after a very strong October, as both macroeconomic uncertainty and inflation concerns crept into markets, and trading firms sought to lock in the end-of-year profits. One of the hallmarks of bearish markets is actually a constructive undertone in supply dynamics, while it's the on-chain activity above points to a fairly anemic demand from retail and market tourists. Coin dormancy remains impressive, and signs of smarter, more patient money accumulating remain intact. December 2020 was the launching point for very strong price performance in Q1 2021, as Bitcoin broke its previous cycle $2,000 all-time high and pushed on the reach over $64,000 in April. If we look at the supply last active 1 year plus metric, we can see that a great proportion of coins accumulated in late 2020 remain unspent to this day. Since October 2021, over 682,000 BTC have migrated to the 1 year plus age band, representing 3.3% of the circulating coin supply. Over 57% of coin supply is now older than 1 year, equivalent to the 51.5% seen at the time of April 2019 bullish impulse. Given how volatile 2021 was, seeing such an acceleration and a large proportion of coins held throughout is quite remarkable. Long-term holder supply has also plateaued after a very modest period of distribution following the twin all-time highs in October and November. This signifies that long-term holders have slowed their spending and are more likely to be holderless, or even buyers at these prices. This provides another constructive view of market conviction. Long-term holders have spent around 150,000 BTC since October, which is just 1.11% of their total held balance. The slowdown in spending is notable given the sharp and sustained correction during this time. Note that it also follows a massive accumulation phase in 2021, where on net, over 2.2 million BTC migrated to long-term holder wallets after March, a balance growth of 22%. We can also assess coin liquidity as a more immediate measure for current coin supply dynamics, such as whether the market is in accumulation or distribution, where the supply less active and long-term holder supply metrics use time as the primary input, coin age or lifespan, or liquid and illiquid metrics uses wallet spending heuristics. When a coin is moved to a wallet with no history of spending, it will be classified as illiquid. For example, a holder executing a dollar-cost averaging strategy. Conversely, a wallet that spends very regularly, for example, day traders or an exchange hot wallet, will be classified as either liquid or highly liquid. We can see that over the final month of 2021, even as prices corrected, there has been an acceleration of coins from liquid into illiquid wallets, Through December, coins moved to increasingly illiquid wallets at a rate of between 50,000 and 100,000 BTC per month, reflecting a higher likelihood of broader accumulation. On net, we can see that illiquid supply has accelerated higher at the expense of the combined liquid and highly liquid supply. Illiquid coins now represent 76% of the total supply and can be seen to have a visible correlation with price. The current condition to speak to a divergence between what appears to be constructive on-chain supply dynamics compared to bearish to neutral price action. Lastly, on the longer-term macro trends, we can see confluence within the liveliness metric. Liveliness reflects the relative growth of coin day creation and coin days destroyed in the circulating coin supply. Where more coin days are created, there is more dormancy and hodling, and the liveliness will trend lower. Conversely, distribution, particularly by older hands, will see more coin days destroyed than created, and the liveliness will trend higher. Liveliness appears to be in a strong downtrend, even as prices correct. This is typical of bearish markets and periods of accumulation, which further adds to the assessment of bearish with bullish undertones. While the supply dynamics for the more patient, smart money appear constructive, there remains a large sector of the market whom are currently underwater on their holdings. While its long-term holders appear to have growing conviction, prices are trading below the on-chain cost basis of their counterparts, the short-term holders. These are the most likely coins to create sell-side pressure and weigh on a market recovery. The realized price is a metric that values each coin at the time when it was last spent on-chain, reflecting the value stored on Bitcoin, and an estimated of a cost basis. The chart below shows the realized price for 3 cohorts. Short-term holders currently trading at $51.4 thousand, meaning this cohort on aggregate is underwater on their investment and are the most likely to create sell-side resistance. Aggregate market in orange, the realized price for the whole market is currently trading at $24.4 thousand. Generally, the realized price provides reliable price support and bear market floors, although it is obviously not ideal to see prices reach this level. Long-term holders in blue currently trading at $17.7 thousand after a steep rise as coins accumulated in the first half 2021 at higher prices remain unspent. This metric can be considered a visual observation of long-term holders valuing Bitcoin at a higher floor value over time. For the short-term holders, the short-term Mvrv metric shows the magnitude of current underwater pain relative to past bearish periods. The short-term Mvrv is currently trading below 1, an event which unfortunately has very few periods since 2017 of being a short-lived event. The bearish periods in 2018, 2019, and mid-2021 also short-term holders persistently underwater, with short-term Mvrv values of 1 acting as resistance. Psychologically, this represents new buyers getting their money back, which puts $51.4 thousand as a key level to watch.